Welcome, everyone, to our webinar today, the Pre IPO Board, preparing the Board of Directors early in anticipation of going public. I welcome you today, and Roberta and I are very excited to talk about this topic. A few webinar reminders and things to mention. First off, our purpose today is to share the knowledge and benefits of preparing the Board of Directors early in anticipation of going public. Please feel free at any point to write your questions in the Q&A section. Our goal is to answer all questions at the close of the presentation. If there are too many questions for us to get through, we'll obviously follow up with you via email afterwards. I always answer this early. Yes, the entire webinar is being recorded, and you'll receive a link via email shortly. This link will also include the ability to view and download the presentation deck in its own separate file. Know also that within that presentation deck, there are links that you can click on to link out to other articles and reference material that we mentioned throughout the presentation. And for those with your IBDC.D certification, you will receive 1 CPE credit by attending. Just be sure to follow the proper CPE credit submission guidelines. Let me welcome who I like to say is the one and only Roberta Sidney. First off, Roberta, understood your background, experienced board director in public, private, and pre-IPO companies. You're a lead independent director and nominating and governance chair of a pre-IPO company in a public REIT, and also non-executive director for a private company that went public via SPAC. SPAC is probably a whole nother topic for us for another webinar. I've also had the pleasure on numerous occasions of working alongside Roberta as a consultant and advisor. We've had our share of interesting scenarios, I'll say it that way. Roberta, it's a pleasure to have you today with us.
Well, very, very nice to be here today. And that's one reason why I wear long sleeves, so you can't see the scars, but the battle scars are there.
Yeah, we've had our fun also, and we've had our challenges. So I'll say it's all in good faith of learning. So that's the process. Glad to have you with us. I'm your host today as well, Mark Pfister. Many of you know me as a governance and strategy expert, a non-executive director, and chief board consultant. I've worked with hundreds of public, private, and nonprofit boards. I've also had the unique pleasure and experience of working with, advising, consulting, architecting pre-IPO boards, and have documented many interesting observations as I've gone through my experience and my work in this field. So Roberta, we can kind of team on these areas from two different lenses and two different viewpoints, you from inside the boardroom, me from outside the boardroom on these topics. And I think it really will lead to some interesting observations and comments for us today.
Great.
Good to have you again. Looking at the path and the goals we're going to follow and what you should think about when you walk away from today's webinar, what are the areas we're going to cover? Quick intro on IPO background, focus, I'll say, to get us kicked off. Talking about some of the background and how IPO started. Talking about IPO benefits, number 2. Number 3, IPO leadership preparation and major milestones. How do we view the timeline and the prep areas of focus will be discussed in number 3. Number 4, pre-IPO board focus. Number 5, IPO board external requirements. What are you required to do legally in your IPO launch? And we'll leave you with some thoughts before the Q&A on the IPO board best practices. And this will be interesting also, Roberta, for you and I to share the different viewpoints on this from both of our different lenses. Let me get us kicked off, Roberta, if you don't mind, and then we can get to some of the areas that I think you bring immense value to. Just for good measure, we start off by saying that an IPO, initial public offering. So this refers to the process of offering shares of a private corporation to the public in a new stock issuance for the first time. And really the main benefit of this is that an IPO allows a company to raise equity capital from public investors. Now, if we go back to the origin of this, and for those that know me, you know that I'm a lover of history. I like to know where we came from. I think it helps us to understand where we're going. And the first IPO dates back all the way to 1602, when the Dutch East India Company, don't ask me to pronounce the real name, I'll just call it VOC. I don't want to embarrass myself. At the time, it was the biggest commercial enterprise in the world. And their correlation to the IPO is that they invited every resident of the Netherlands to buy shares to help finance its trade in spices and other commodities. So quite an interesting start. And we'll see shortly how that's evolved into how we use this methodology and this option today. Another quick aspect of this, we know that the IPO is the action that sits between going from a private company to a public company. And we should keep in mind in this, just a few initial pieces to point out. Founders, CEOs, and insider board members, if they're already appointed, can commonly be short-sighted in their formal board composition focus until they're forced as a requirement to become a public company. Roberta and I will point out some of these areas that you can draw in earlier and closer, I'll say, in the pre-IPO phases that will help you in making sure your company is prepared and that your efforts are focused properly post-IPO. We should also keep in mind that the growth implications of an IPO company are far-reaching and the rewards can be incredible, but we have to know how we should prepare for this and what exactly are the important focus areas. And with that, Roberta, let's talk about the areas here that are the advantages of becoming a public company.
Sure. And again, for those listening today and viewing us, it's great to be here. Today, we're really going to talk about what you should be doing to get ready to go public and how you can prepare with a board in advance to be ready. But it is really important to understand why companies go public and what that's all about. So the first one is really all about cash. Oftentimes, private companies can grow so far, they bootstrap, friends and family, maybe venture, maybe PE. But in order to really get a significant amount of equity and cash to grow, they go to the public markets. And so that's really one of the big things that's available to them. The other is if you have stock in your own company, you can use that stock to make acquisitions, which is part of an M&A and growth strategy, which again, not to say that a private company can't do it, but it's one reason why some companies choose to go public because it does make M&A easier in some respects. And the last is talent. We all have been seeing whether it's the quiet quitting, the great resignation. Stock and being an owner in a company is something that you can do and you can do very handily when you're a public company. And so being able to reward your key players and give incentives, vesting schedules, and so forth is another reason why companies go into the public markets, because it is a way to keep their key people and instead of having them go off and become a founder of the next private company, if you will. So that's some of the benefits. The next slide is that there are also some other things to consider. So again, this is not today's event here and webinar is really not about helping you decide whether or not you should go public, but you should be aware that when you go public, if you go public, or if you're on the board of a company that is considering going public, there will be additional regulatory requirements. There's 10Ks, there's 10Qs, there's proxies, there's audits, there's all sorts of review, which adds to time and cost. And I'm not talking just about management, but I am also talking at the board level. There's market pressures. All of a sudden now you're being compared. There's a price to your stock. It's being quoted. You're having analysts say, buy this stock, don't buy this stock, sell this stock. So it is for some people that's good because people like competition and it works really well, but it is one of the facts of life of being a public company. The third is potential loss of control. When you're the founder and you control the company and you've got, whether it's 51% or just the most of the stock, no one is going to end your reign, if you will. When you are a public company, you now answer to the shareholders and to the board who hires and fires you. So you can be tossed out of the company that you started. So it is something to think about when you go public. And the last, and this one is a big variable here, but transaction costs. It is not simple to go public. It costs real money. There are IPOs, initial public offerings, that don't cost tremendous amounts. And then there are those that cost in the tens of millions of dollars. And this is for legal fees, audit fees, of course, your investment banker fees, registration fees. And again, that doesn't even count all of the extra time and energy and the consultants you might hire to take a look and say, what do we have in our internal financial controls, by the way, in advance, to understand what you need to do to shore up your own house. So there's a lot of costs that go on to making the decision to go public. I'm not trying to discourage anyone. I just want everyone to understand that if you are getting on a board of a company that's going public, or you're thinking about getting on a board of a company that's going public, these are part of the equation that gets considered.
Roberta, a couple of quick comments. So on the previous slide, when you talked about incentives on the positive side of IPOs, it can really be a great incentive in that it's not causing a cash basis crisis, I'll say, by offering the equity early on in these organizations and still attract the type of expertise and experience that you're looking to have on the board. Also, the potential loss of control that we talked about here, this is a common fear that I hear of most founders and CEOs that are running their private companies. It does have a backing in the history that we've seen that many founders are at certain points pushed out. But there are aspects that they can control, and they can actually set up their voting ability through different bylaws and to protect from some of that potential loss of control in the process. All right, so if we talk about an ideal IPO preparation timeline, I kind of smiled a little bit to say that wouldn't it be great if all IPOs actually had a 5-year runway before they went IPO? I mean, just think of the beauty of that and the time frame. But I want to point out we're talking about an ideal IPO preparation timeline. Keep in mind that if you are a director on a board, or it's some area of an organization that is involved in the prep work for an IPO, start to think about this in a time frame that is very manageable. And we'll talk about some of the reasons why it's important to keep this longer runway whenever possible. So if we look at this year -5 or 5 years out, typically the company is either hiring a new CEO, if it is going to be different from the founder, and this will be the CEO that's in place who eventually takes the company public. This is pretty common where that CEO is transitioned to someone else who will be there both pre and post IPO. In many cases, the founder actually will join the board. But I want to focus even more so on the importance of culture and the time commitments. And Roberta, from our discussions, we talked about through our experiences working together, that this adding to existing day jobs, I believe this to be one of the most overlooked areas, especially when we're looking a few years in advance of the IPO. How does this action or this focus of the IPO and taking the company public, how does it add to the existing day jobs? I can tell you our focus typically is spending time understanding how the company is structured and setting the expectations. There's going to be additional work that's required in bringing this company public. So I think one of the big things to remember here is this adding to existing day jobs, and as a good leader focused on the culture of the organization, making sure that this is understood up front and setting the expectation that there will be additional requirements of those in the organization. And quite frankly, how you may be able to offset that with focus areas from outside consultants and advisors during that process. Year number 4 in advance of IPO, in the ideal scenario, company implements the financial and accounting systems to be in place at the IPO. No better process than to start both the areas of your tracking and the more formal accounting and auditing systems that are going to be in place early on. Your underwriters are going to be happy about that. Your general counsel is going to be happy about that. These are all things that build confidence in the company. And also the company would likely consider as soon as possible around this time frame of hiring the outside accounting firm and the external auditor used also at the time of IPO. Year 3, development of a corporate governance system. Now, in many of this speaking engagements that I do, when I mention this, I get questions about, well, what do you mean by a corporate governance system? The main point of this is that the organization is aware of the model or the governance model that is going to be used. For those of you with the IBDC.D background, you understand from the course that we're talking about a comparison of the different governance models, such as the traditional model, Carver model, Cortex model, consensus model, competency model, or as many organizations choose, a mixed model of those 5 different governance systems. Companies recruiting, most likely it's first independent or outside board member. Company recruits the CFO is another great step at this year -3, who eventually also is involved in taking the company public. And this readiness assessment, Roberta, this is something that you and I have spoken about over the years at length. How do we know where we have gaps in the organization? For us, it's typically been a reach out to an organization, I'll say, that we engage as a third party to bring in to do this system of controls checks and looking at the timeliness and any areas that require remedial focus well in advance, or at least in advance of year two. So we're on track for the IPO focus areas. Year two, we typically like to see that a company's hiring an in-house general counsel. And you also start to see these meetings that we call testing the waters meetings. These are really focused on informing a management team about whether or not they should endeavor to raise capital from the public equity markets. In a nutshell, it's truly making sure that you have something that will be marketable, you have something that's wanted, and you have something that investors feel comfortable investing in. Roberta, I may actually pause there for a moment and just have you weigh in. I know that you've been involved in quite a few testing the waters meetings. Right. Anything else you want to add to that?
Yeah, no, thanks, Mark. I think it's an important point to stomp on, because here it's sort of a litmus test of having management go out, speaking with analysts, speaking with potential underwriters and saying, does our story carry water? Will it carry water with the people that you might be presenting it to? And I've seen on more than one occasion, either management needs to kind of hone their story a little bit or emphasize certain things more than other things. Or I've seen management trying to be all things to all people, which is then confusing to the market. So these test the water meetings can be really, really helpful at putting up the mirror and having real life feedback on, well, what are you exactly? What problem are you really solving? Who is your customer exactly? And show me how that growth track record that you have is going to continue, and we're going to see the hockey stick going up to the right.
And I'm sure you've seen also that those testing the waters meetings in many cases has forced the company to come back and reevaluate how it describes its product and services to be more investor friendly, or being able to correlate more so to the market areas that they're targeting.
But also, and again, I can't speak to right now because the market is so squirrely, it's hard to know, but sometimes you're trying to position yourself against certain peers and to be in a group with a certain kind of multiple. And what you're trying to find out is, does that wash? Do people believe that? Do they see that what you're doing is peer-like with this other group, and that would then put you in that kind of a multiple, whether it's a tech company, a manufacturing company, a SaaS company. So that's really important. And yes, you're right. I have definitely seen some retooling after initial test the water meetings. And what I've also seen is preliminary test the water meetings, secondary test the water meetings, and then real test the water meetings.
Yeah, and these can become quite the effort in the organizations also. I know with the prep time leading up to these meetings is quite involved. So absolutely, thank you. And I also mentioned here, for good measure, the shareholder relations plan. It's all too often we kind of see that as a rushed exercise, even in the year one leading up to the IPO. I think it's great to combine the shareholder relations plan, or at least the early stages of that, alongside the testing the waters meetings. I think they sort of go.
Let me just jump in on that one for 1 second, Mark, because I think beyond shareholder relations, what I've seen kind of bite people in the butt is their shareholder system. Because when you're a private company, it's very different in terms of what kind of system you're using to track who owns what and what the cap table looks like. But when you're moving into the public market, you need something more sophisticated, and building in the time, which again, you've called this the ideal timeline. All of these steps have to happen, whether it's 5 years or 3 years or 2 years. But I do think the other piece is you have to definitely look at your shareholder record keeping system.
Yeah, and I know that many companies that are doing this correctly, they actually have their line items, whether it's a budget aspect of it or the scope of what they're required to do in that. So absolutely, great point, Roberta. Thank you. And the hope in all of this, and as you pointed out, Roberta, the ideal preparation timeline is that by the time you're in this year -1, that you're hopefully at the point where you have a fully built leadership team. And I don't just mean the C-level, I also mean the board, of course, which is the purpose of this particular webinar. This allows for the leadership team to gel. And I want to just take a moment and talk about this, that it's all too often we see boards that are quickly put together and they're expected all of a sudden to be in full operations mode, especially at the day of IPO. And in some cases, I've seen directors meet each other for the first time the day after the IPO had happened. And I can just tell you, as you can imagine, that's not the ideal scenario. There is something to be said about allowing time for building up camaraderie. There's time that's required for a leadership team, as I say here, to gel. And I don't want to, by any means, undermine the time that's required to gain trust between the leaders of an organization, especially in the boardroom. The key to all of this is getting to the point where you have your fully operational board of directors prior to the point of the IPO going live. And part of this is to focus on getting the value from that team being in place prior to that IPO.
Yeah, that's, again, ideal is
Yeah.
the operative word there. And there's an awful lot that needs to get practiced in advance, not just closing the books in a quick manner.
Let me just throw the question out there, Roberta, that the audience may appreciate. Now, I'll tell you what my number is after I ask you first. What is the typical timeline of prep in years or months that you have operated in as it relates to pre-IPO activities?
I haven't seen more than 24 months from the time of let's do this to, now we're here. So that's been my experience. So I would love to say that it's more than that, but I haven't seen that. And again, maybe some of that is because of the frothiness of the SPAC market, which got a lot of people thinking about public markets. And so everyone said, oh my God, we should all be public. But that's been my experience. It's a much more compressed timeline, which again, makes it more chaotic.
Yeah, I would agree with that. I'd say typically in my realm, I'm looking at the 24 to 36 month. However, if I was truly digging into what the organization was doing in that 5-year point, there are certain things I could pull out that maybe they weren't thinking that they were directly related to the IPO, but could be leveraged for the IPO. Much of this coming back to them wanting to become a more mature organization. Typically, we're looking at that as governance aligned areas that they've been focusing on. So I would agree with you on that.
Yeah.
The 24 months can be quite a busy time frame to cram all of those aspects into that 24-month period. Hence the reason we talk about understanding what that burden will be or the time commitment for a board and for those within the organization to compress that timeline.
Yeah, well, it becomes much more of a sprint than a marathon, and you need more energy for a sprint. At least that's what my runner friends tell me.
Yeah. Got to be on the lookout for burnout during that time frame.
Exactly. So, what I would say here, and this is an area where I've been the NomGov chair, I've been the lead independent director in pre-IPO companies. And the first thing that you really need to think about is you are building a team. And I do ascribe to the philosophy that Mark espouses in his book, Across the Board. What you're doing here is you have a multi-dimensional construction of your board team, and you need a team that's fit for purpose. And fit for purpose is not going to be the same for every company. It really is going to be a bespoke team based on what this company is doing in this industry at this phase of its growth cycle. And that's the first dimension there. So in the sphere of influence, you're really talking about the board expertise. What do we need? It's going to depend on industry. It's going to depend on so many things, but this is your board's expertise here. The second dimension here is the planes of congruence, which is really about your board's character. If we were putting together a baseball team, we would not bring in 9 pitchers. We don't need 9 pitchers. And the same is true on a board. We do not need the same type of person in terms of personality type, background, and so forth. So it's really important to think about the planes of congruence. And then the coverage and balance is really about the depth. In my humble opinion, again, I think this makes a lot of sense. If there's only one person that can spell the word cyber who is sitting on the board and no one else knows anything about it, that is not going to be helpful to the company and to the board as a team, because somebody will come in, the CISO or the chief tech officer will come in, they'll say something. This one person on the board who knows something about cyber will say something else, and no one else will challenge or ask a question or do anything. So super important to have not just one, but at least 2 in your key critical areas. So it's about these 3 dimensions and getting it right. It is hard to do because you don't want to have a board of 20 people. So if you're having a board of 5 or 7 or 11 people, you have to find people who are going to fit together almost like a mosaic or puzzle piece where you can get the best team on the field that cover all of these areas. And there might be a few gaps and you may have to build to it over time, especially if you're doing a rebuild, but this is where you're trying to go to. The second point is you obviously need to comply with what the regulations say. So if it says you need a certain number of this, a certain percentage of that, pay attention to that. That's part of certainly planning your board composition. And then the third piece I would say is you must, to be a public company, you need 3 standing committees, sometimes 4 if you're a financial services company, but you must have an audit committee, you must have a compensation committee, and you must have a nominating and governance committee. And it is my opinion, again, that especially if you're going straight from private company with no one on the board with any public company board experience, and now you need to be a public company board, and these 3 committees, you want to make sure that as you go out and recruit people and go out and attract people to your board, you're seating or looking for people that you can seat at the helm of each of these very important key areas. And then, of course, the last is if there are other areas, whether it's ESG or whether it's technology, again, depending on the company, you may want to be thinking also about how do I find the people who could really add value on this committee of the board. I'm sure you said this before in some of your other programs, but most of the work of the board gets done in committee because it's just, that's what has to happen. So if you don't think about architecting or composing your board in a way where you have the right people for the committees, it all falls apart. So it does start there.
Exactly. And you know, Roberta, from our time working together, I'm always the one that's needling and pushing for a risk committee and a strategic planning committee. You've heard me say that many times as well.
Yeah, absolutely. Absolutely. So here's some of the things to think about. And again, I kind of gave you a little bit of a teaser on this one. If you're coming into a situation, and I have certainly been in this situation myself, where there is no one who has prior public company board experience, you want to put some on your board. And I would suggest that 50% would be a good number so that you can keep some of the people who got the industry knowledge and the organizational knowledge, but that you're also adding people who bring that other expertise. They've already been to the show and they're going to help everyone be better for it. The second is, again, if you can find someone who has prior experience with an IPO, maybe also M&A experience, that can be very advantageous. They know what to look for. They know where the pitfalls are and the minefields. And then last, it can be important too to have someone who's got some legal experience, who can be asking the right questions. You also want to have, of course, a law firm that knows how to do this. You don't want to be having them learn on your nickel, but it can also be helpful there too. On the right side of this slide, I think this is really important because I think people sometimes misunderstand when a company goes public or when a company can go public. And it looks often that, well, you've got to be a really mature company and then you go public. And then in the last few years, we've seen it very differently. We've seen companies go public via SPAC with basically an idea and no revenue. So they could be a growth company in the very early stage in number 3. They could be an established company in number 4. They could be in an expansion mode in number 5, or they could be a mature company. And the point here again is fit for purpose. What's the industry? Where's this company at in terms of its growth trajectory? What kind of skills are going to be needed for where you're going as a company? What do you have already? That all factors into how you think about the composition of your board, the makeup of your board, and having a board that, again, I've said it now at least 3 times, that is fit for purpose.
I like the terminology of fit for purpose because it forces you to think about where are we now and where are we going? Not just the one-trick ponies that can help you get through one of the stages of this. So great point, Roberta. Thank you. To one of your earlier points, Roberta, when we talk about the requirement areas, I thought it would be worthwhile to take a look at some of the requirements, and we'll use the two US examples, one for NASDAQ exchange and the other for the New York Stock Exchange, and just point out a few areas that talk about what are these mandates, what's required of a IPO board, and are there timelines to this? And the answer is yes. So on NASDAQ, let's talk about them first. They are looking for and mandating a majority of independent directors within 1 year of listing. And then they have their requirements, of course, for their independent audit committees and independent compensation and nominating committees. So if we look at the audit committee as an example, at least one independent member at the time of listing, a majority of independent members within 90 days of listing, and a fully independent committee within 1 year of listing. Pretty much the same also for the compensation and the nominating committees on a whole. We're going to come back in a moment to what we call these grace periods that you're allowed in a post-IPO board and what those timeframes are. Now, if we look also at the comparisons to the New York Stock Exchange, very similar in the mandate for the majority of independent directors, independent audit committee, very similar in the compensation and nominating committee independence. But there are a few other areas that this particular exchange considers to be important and that they measure by. They're a little more prescriptive. So number of audit committee members, as an example, 1 member by listing date, 2 members within 90 days of listing. I won't read all of these to you. You can see it here. When you receive the presentation, you can click on the link at the bottom here and see everything, whether it's IPO or requirements and the reporting requirements. This particular article is quite a great reference and source for seeing those requirements by the US exchanges. If we compare this to global or outside the US exchanges, they're fairly similar, a few nuances here and there. The main point that I'm trying to show you here, however, is that the exchanges themselves do allow for grace periods. But I want to point out specifically that should we actually leverage these grace periods? And my point in this, before Roberta goes into some detail and some of her experience in this, is I typically say, why should we wait to architect an ideal board or implement these board composition mandates during the IPO process or within the grace period? I go back to something I mentioned just a short time ago. There are so many benefits to accomplishing this mature board and the structure of this board earlier, well in advance of the IPO. So the organization is getting the value, and you're also allowing for that gel time and that camaraderie and that trust to build.
Well, I can't agree more. I think that what you're going to see here on this slide is really what you can do, which is be in the grace period on the left side, which is not what I recommend. I would recommend being on the right side of this slide. And here's why. And I'll use another analogy. If you're on the left side, it's going to feel like you're trying to make dinner while they are in there renovating your kitchen. So you are in the throes of it. You're getting out your Ks, your Qs, and you're doing everything. And you're also now recruiting directors to the company, and you're trying to get things done on time. It's very, very hard. So you're going to expend a lot of effort doing that. You're ramping up those committees. The settling in doesn't really happen because you're waiting till afterwards. So I don't recommend the left side of the chart, but again, you can do that. There's nothing wrong with it. It's just, again, based on my own personal experience, it's not something I would recommend. So what I would recommend is that you start early. And again, I don't think 5 years is what I've seen. I'm not sure I'll ever see it in my lifetime, but certainly the more time you have, the better. And to have the board know one another, have been working together already, having had some experience perhaps with the MD&A and closing the books at the time that you need to in order to meet the public requirements, all of that is a good thing. So you're focusing then on strategy, you're supporting your CEO and the leadership team, the committees are already in place, the charters are approved, everybody knows what they're doing, and that's happening before you go live, not sitting there at the exchange, ringing the bell and saying, oh, so nice to meet you, who are you, and tell me more about yourself. So again, it's a strong preference. It's not a requirement, but I would say I think it's the right way to be ready in advance. And the last thing I would say is, if you are ready in advance, it makes you look better too, because whether it's the S4 or the S11, depending on whether it's an IPO or a SPAC filing, if you've got board directors in there that are qualified board directors and that look great to the audience you're pitching your stock to, that's going to instill confidence, and that's going to add value to your IPO and so forth. So I just think there's so many reasons why you should start early and get done soon. But again, it's not a requirement. I don't want to tell anyone here that it's a requirement, because it's not. So I feel like I've already covered this one though here, Mark.
That's fine. That's fine. Yeah.
Because again, I'm telling people they should really start early. I would say though, I'll just cover quickly the point on the bottom is sometimes you have to rush your timeline because there's a market opportunity that's just too good to miss. And, the windows aren't always open. We've seen this in the market in the last, 12 to 18 months with what's happened with the IPO market. So sometimes there's a reason to be more aggressive with your timeline. And I wouldn't, I would not suggest that you wait just because you want to be slavish to no, we can't do it before 36 months. Sometimes you do and you should.
Yeah, I think that's a great point, Roberta. And I think both of us have been in scenarios where just about at the 11th hour, we're through all of the focus areas to go IPO, and simply the market's not right at that point. And that decision has to be made. Typically, it's the right decision if the markets aren't correct, and maybe wait for a later date in those areas. But you're absolutely right. I think that timeline is of utmost importance, or the market timing. Great point. Let's do a few summary points, and we can then go to the Q&A for any questions you may have. So a few things to keep in mind as you take away some of the important topics that we've touched on. So business founders, CEOs, and insider board members, we mentioned they're commonly short-sighted. Doesn't need to be that way. We can change that. We understand that we can build this into a focused and very productive timeline. Whether it's 5 years or not, that's up to you. But at the very least, if you can aim for that 24 to 36, closer to the 36, quite good. But the steps now of where to focus. Roberta, you mentioned, I think 3 times this fit for purpose team. It's all too often we see directors that are being approached to join boards, especially pre-IPO boards, when they may not have exactly the experience that is required for that growth phase or that transition from private to public company. So this fit for purpose type of approach can't be stressed enough. Direct focus and preparation, attracting and appointing great non-executive directors. Now that should be the case for any board, whether you're pre-IPO, post-IPO, private equity, whatever it may be, nonprofit, we could say in this area as well. But just know, try to get the benefit, as we've mentioned, of that board being in place, operational, making a difference, adding value prior. And don't be the post-IPO company that's trying to focus on governance and strategy components of a post-IPO company, and you're also focused on building out your board or finding the right people. Time-wise, I quite frankly, Roberta, find this to be almost impossible. The board is already overloaded in most cases in those early stages post-IPO, so why not pull this earlier? And we mentioned a few times about this time for the board to gel and create camaraderie. Before we go to Q&A, quick reminder, I know we have a lot of folks on this webinar that have already been through, graduated, or are currently enrolled. If you're looking to find out more about not just modern day board operations, but also modern day board director candidate packaging, while also earning your globally recognized international board director competency designation, I welcome you to visit our website to find out more about that education and certification program. Please enter your questions in the Q&A area, and we have a few starting off here, Roberta. Let me go to the first one here. Should a director allocate more time in their role during pre and post IPO scenarios?
Yes.
Absolutely.
Yes. And yeah. I will say, and it's an easy yes, but I will say one of the things that isn't generally part of your job as a director in general is interviewing potential directors. It becomes part of your job when you're doing this board build process, and it takes time. And just to give people a sense of things, on one of my pre-IPO boards, and I know Mark, you and I worked on that one together, we were looking for several directors. We had reached out, done a very wide canvassing, I'll just say, with a very specific criteria for each of the roles. We had 700 indications of interest. So if you're on the NomGov committee and you have 700 bios to go through to cull, we got it down to, I think it was like 290 or something like that on the first round. We didn't meet 290, but we probably met 50 odd people, winnowing it down to the final few that we ultimately did seat. So my point is, yes, it takes time. It's interesting work, it's fun work, but it does take time.
Absolutely, I would agree. Well said. All right, I think we may have answered this, but I'll read it anyway. Is it realistic to compress the leadership prep and milestones timeline in scenarios where market timing remains of utmost importance? Absolutely. We've stated that also, that it's most likely that the majority of your work ideally is going to fall within the 24 to 36 month time period. If you can do the 5 years, hats off to you, but typically you're likely going to be in that 24 to 36 month time frame.
Mm-hmm. Yeah.
Here's a question. If the founder of a private company typically becomes the CEO when the company IPOs, when and how is the chairman of the board elected and chosen? So let me take the first part of that, Roberta, if you don't mind, just to mention that in more and more instances, the founder of the company is not the CEO at point of IPO, or if they are not for a long time post IPO. Let me first say that. And maybe you want to touch on the second half of this. When and how is the chairman of the board elected and chosen, Roberta?
Right. Well, best practices with CEO and board chair is two different human beings. Let's start with that. And oftentimes, again, with a new board or a board where you're really building, if there isn't somebody who's already in place who could be the board chair, that might be one of the roles that you're recruiting for as you go forward. But the board chair is elected. It is a role. It is not a lifetime appointment role. It's not like a private company, and so it often does get rotated. And the NomGov committee is in place there to make sure that you've got the right person on board chair or lead independent director, as well as the chair for each one of the committees. And we've covered what those committees are. Mm-hmm. So it's not the founder. I want to just come back around to the question. It is not the founder who says, "Okay, we're going public, and I want this person to be the board chair." That's generally not how it works.
Yeah, great point. There's two questions here I'm going to combine. So let me read both of them, Roberta, and then we can weigh in on this. So first question of a similar ask: what, if any, specific or additional challenges occur when a private equity firm moves towards an IPO? Number one. Number two, many pre-IPO boards have investors in appointed board roles. Many of these investors are solely focused on finance and protection of their investment. How do you maneuver through board changes and what should be expected? Both of these are great questions. Roberta, I know from our scenarios, I think they've all been involved in having those investors early on. I'm going to first start by saying it's not an easy process. It requires a lot of diplomacy. But yeah. Well, why don't you take it first, and I can chime in, Roberta?
Sure. So I'll answer the second one first, because I think it's a good way to think about this. In general, when investors are going now to the public markets, it's to cash out, and so these investors have zero expectation, by and large. That's been my experience, or very, very small expectation to be staying on the board once it goes public. They're looking to get their 2x, 3x, 10x, whatever, and have a good board in place that goes off into the sunset. So they're not looking to be on the board long term. And so there's not generally an issue there. The tricky part is in going from where you are today, which is now we have this private company, we have the investors on the board. Now we're going to be changing the board in some way, which changes the dynamic in the boardroom and changes the power dynamic in the room when you bring in new people in preparation to be launching the company as a fully independent board, where some people are shed as part of the IPO. In that pre-shed period is the part where diplomacy is definitely a big key. I'll leave it like that.
Yeah, I would agree that on the pre-IPO side, that's where the majority of the challenges lie in my realm as it relates to the consulting and advisory space. There is some tiptoeing around when this first starts, especially with new directors coming in, kind of feeling their way. Let's be frank, the majority investors typically have most of the power before you got there. They even probably have a significant sway over the CEO and probably were involved in selecting the CEO if it's not still the founder of the organization. So there's a lot of dynamic in this, I guess, is the diplomatic word to use, is the dynamic of this early on. And I do think there is a component of the process of implementing the board in the proper way. Roberta, we talked a little bit about the board architecture components. I think there is a selling component of this to show the value, not just in the pre-IPO phases, but also how that brings benefit in the post-IPO phase as well.
Yeah. Well, and we talked sometimes, and we didn't really talk about it today, about the onboarding, but also the orientation pieces of a board. And I think whether people are staying on or not staying on long term, it's really important as you go through this IPO board readiness process that you have a concerted effort to bring everyone together as one team. It isn't the old people and the new people and they don't talk. It's we are a board. What are our norms? How do we do things? How are we going to organize ourselves? What work are we getting done? And so I think the more, again, time and energy you can put into that and structure, I think it makes it a whole lot easier to have those conversations because everyone understands, oh, okay, we're growing up our governance. I get it. And now I see the role I'm playing, at least in this interim period, until I leave the board post IPO.
Roberta, that is a great point. I didn't even think about talking about that today, but my experience also is challenged in that area, I'll say, with these boards, because in many cases, the incoming new directors are more formal directors than those that were in the private company board. So right. How do you level the playing field to this? And it does typically require that those existing directors do need to level up their game, quite frankly. So great point.
Yeah, well, I've seen this even in private company boards. When private company boards are bringing in independent directors for the first time, you see the same dynamic there too, because they've been there because they're family or they're founders or they're part of the closely held group. And now you're bringing outside expertise. And it's like, okay, the newbies understand what board governance is. The people who've been there all along understand the business really well, and they may even work in the business. And then getting that team to gel, it's magic when it works, but it doesn't happen without work.
Absolutely. Yeah, these are pretty tricky scenarios, I'll say, as it relates to private companies moving into that public space. There's a lot of dynamic in this at the leadership levels, as well as the organization upping its game in many cases to move from that private to public realm. All right. I think, Roberta, that's all the questions that we have relating to the IPO board aspect. Anything else you want to add? It's been a pleasure having you with us today, Roberta, with your background and your experience. I always enjoy our discussions and working together with you.
Well, same. It's been great. No, I think we've covered the landscape here. Hopefully, we haven't scared anybody away from considering a pre-IPO board with the work we've talked about and how much time it takes. Because it is a very exciting time in the evolution of a company. It's not for every company. Sometimes companies don't go public or don't need to go public, but it's a really exciting experience to be part of it and something to be really proud of when you get all the way through to the other side.
Great. Well, I first thank all of our audience today, from especially those that are at very late or very early in the morning right now from around the world. Roberta, I thank you so much for joining us. Great discussions, great content. Your experience is unparalleled when it comes to talking about these particular topic areas. So thank you very much. I'll see you soon. Thanks again to everybody for joining.
All right. Thanks for having me. Take care.